shares of Peloton coming off of the lows of the session, but still down more than 3% after the company issued weak guidance for the holiday quarter, even though the company's CEO says, quote, the ship is turning. Joining me now to break down the results, we've got Citi Senior Analyst and Managing Director Ron Josey. And Ron, okay, so we can focus on the negative. We know this has been a turnaround story for some time, but I want to flip the question and start with what I think could be a positive. You say this is, sort of the turnaround story is starting to take hold. And we did hear from CEO Barry McCarthy today saying that we're done now in terms of slashing headcount. I mean, what's a silver lining out of this report, if there is any?
Yeah, no, Akiko, it's a good question. I mean, because we can talk about the negatives for a while here, and there's some things that we definitely need to be aware of. But the bottom line is churn improved in the quarter. We have newer distribution models with third parties like Amazon and Dick's on top of Peloton's first party that should help drive continued growth. You have a cost base that is significantly reduced. I think employees are down over 50% really since February. So really what you have here is a streamlined business that has a tremendously engaged member base where churn is coming more in line with historicals after the pricing increase. And you have visibility, or at least we think there's visibility into greater overall or positive free cash flow towards the end of this fiscal year. So in the back half of this year. So the silver lining here is, look, turnarounds are hard. We know that. Churn is improving. That suggests engagement remains strong. And frankly, these newer things that the business has been doing in terms of third-party partnerships, their rental program with Fast, things along those lines, they should improve overall results over the next couple of quarters going forward.
And Ron, you were on that call today after the earnings results, specifically asking about free cash flow guidance and what made the leadership team feel confident about beating the one-year timeline. I mean, how confident are you in their strategy? And did you feel like you got a satisfactory answer?
Yeah, no, it's a really good question. I think the answer is yes, right? I think when you think about the changes that have happened in this business and really just the last 6 to 9 months between the multiple rifts, between basically going from insourcing or being a verticalized strategy from creating your own bikes or manufacturing your own bikes to delivering them yourself to outsourcing all of that, this business has gone through a tremendous amount of change. And so as we take a step back and we think about where we are today, the cost base is much lower. So in other words, the variable cost structure is certainly better. The member base seems to be stabilized, which is strong, and that gets to engagement. At the end of the day, our core thesis here is that engagement drives everything in this business. And our view here is that those members that are on the bike stay on the bike for a while here. And it's something that we haven't really seen in other type of consumer subscription models. So that's positive. And then you add to that, we're going into the holidays with newer distribution partners. And so all this combined should help drive better free cash flow at the end of the year, as we just talked about. But does it give us more confidence? I think the answer is yes. Now, to be clear, there's changes in this business, right? So the Fast business or the rental bike business, it will change the structure of when Peloton generates the revenue. Their distribution partners, third-party distribution partners with Amazon and Dick's will have a lower overall selling price because it's more of a wholesale partnership for the most part. That'll impact revenues. But I think the profitability should start showing up here over the next couple of quarters. And that's really the key thing of proving out the viability in the business here. So the top line seems to be stable, at least in subscribers. That's good. And overall costs are pretty much taken out. So we're a leaner, more streamlined organization that should drive greater overall profitability and sustainability in the business.
Finally, really quickly, I mean, this doesn't change the fact that this is a stock that has seen a steep fall this year. We're now looking at $8.47 a share. If the turnaround strategy is working and you feel like things are taking hold, is this kind of where fair value should be?
So, I mean, it's a good question. Our price target, published is certainly higher. If you would strip out everything and just look at the subscriber base and where it is, the 1.2% X some one-time things there's a lot of value in that subscriber base. And as a result, we think there's a lot of value in this business. And we think shares are not reflecting that because the turnarounds take time, especially one of this magnitude, especially one that, went through the pandemic with massive demand being pulled forward. And now we're in a completely different environment and macros coming up here as we just heard your prior guests talk about in terms of concerns. So, from a fair value perspective, we think there's room to go on shares. That said, we understand it's a turnaround strategy. There's a lot of moving pieces here. We want to see that free cash flow better. Our model suggests we could get there, or we can get there. And that's really what's going to drive shares here in the next, call it 12 months or so. And that's our vision, our longer term focus on the name.
Ron Josey, Senior Analyst and Managing Director at Citi. Always good to have you on. Appreciate your insight today.
Thanks, Akiko. Likewise.